On behalf of Sallie Mae's 8,000 employees and the more than 20 million college savings and student loan customers, I thank you for the opportunity to testify on federal student loan reform and the opportunities it provides for increasing student aid. The administration has made an important proposal to reform the federal student loan programs. At the outset, I want to underscore the significant agreement between Sallie Mae and the administration's objectives of reforming the federal student loan programs and increase funding for Pell Grants. Sallie Mae proposes to build on this model with modifications that would preserve beneficial competition in the delivery of loans, create incentives to materially reduce defaults, and eliminate the risk of requiring more than 4,000 schools to convert to a new loan delivery process within the next 9 months. We believe our suggestions would preserve the value added by loan originators, including state and nonprofit providers, help all students better manage their debt burden, and increase the savings available for the Pell Grant program. The President's proposal builds a solid foundation for a new federal student loan program by utilizing federal funding, establishing common loan terms, and replacing a subsidy model with a fee-for-service model. We believe, however, that it could be made better. Specifically, we recommend the following 6 enhancements. 1, we would allow schools to choose the loan originator that works best for them and the students that they serve. We would introduce risk sharing so that all servicers have skin in the game and loan defaults are minimized. We would allow originating lenders to retain servicing regardless of their size, and permit schools to choose their loan servicer. We would require the Department of Education to set origination fees via market mechanisms to preserve a broad participation of originators, including state and nonprofit service providers. And finally, we would require the Department of Education to fund default prevention initiatives, such as financial literacy programs and student counseling. The benefits of these programs and these modifications are significant. Using the existing loan delivery infrastructure eliminates the risks and costs associated with the conversion of more than 4,000 schools to a loan origination platform that they did not choose. After 16 years of FFELP and direct lending competing side by side, it's fair to say that schools have chosen the loan delivery system or process that works best for them and their students. Great products and services result from consistent competition. Competition, through the choice of loan providers and servicers, will drive innovation and improvement in these programs. Mandating that all schools use a single loan originator will eliminate this competition and any incentives in innovation for improvement. Today, loan originators add significant value beyond the delivery of funds. The new income-based repayment program, or IBR, is a great example of how competition adds value. IBR will help lower-income borrowers shrink their payments to a manageable portion of their income. For students to benefit from this new tool, however, they need to be aware of it and know how to use it. To make sure this is the case, Sallie Mae has held school-based workshops on IBR since January, 6 months before the launch, and has been asked by several direct lending schools to provide these same workshops for their students. These efforts are an example of how competition creates enhanced services. Because we compete, lenders, secondary markets, and guarantee agencies are all incented to create value-added programs and services. These initiatives are particularly valuable to schools and families with limited resources, and some of the examples include financial literacy programs and tools like paying for college calculators and seminars, customized technology interfaces for schools, and outreach programs that help families understand, plan, and pay for college, including customized programs for Hispanic, Latino, and African American students and families. A specific example is Sallie Mae's Education Investment Planner, a free tool that helps students and families save, plan, and pay for college. I would also like to highlight the cost-saving aspects of our suggestions, some of which may not be captured by CBO models, but are real nonetheless. Our risk-sharing proposal would generate substantial savings. a modest 10% reduction in default rates, only 1/3 of the 30% that Sallie Mae has actually achieved, would prevent more than $1 billion in loans from defaulting, sparing several 100,000 students from the negative consequences of default. A delay in the conversion of the more than 4,000 schools into the Department of Education's loan origination system would materially reduce the savings and could potentially disrupt students' access to loans. By allowing schools to use the origination platforms that work best for them, implementation is guaranteed and the savings would be realized. Finally, using a market-based process for setting fees will ensure the lowest cost to the taxpayer year after year. I hope I've been clear. Sallie Mae supports the administration's objectives in reforming the federal student loan programs and increased funding for Pell Grants. We are not trying to preserve lender subsidies. We are offering recommendations that build on the foundation of the President's proposal, particularly the use of low-cost Treasury funding for all loans, and with such changes, we and our competitors can guarantee the seamless delivery of student loans and meet the financial objectives of the administration, this committee, and America's students and families. Thank you, and I'd be pleased to answer any questions you may have.